Welcome to Dan's On Site with Dan Dutton and Dan Goley, a podcast and YouTube show dedicated to all things real estate, delivering market information, interviews from all perspectives, and tips for everyone involved in or interested in real estate. We'd love to hear from you. Dan's at dansonsite.com. Hey, welcome to Dan's On Site. We took a couple weeks off over Labor Day. I mean, Goley was pretty much barbecuing the whole time. It was crazy.
I didn't share any either.
No, he kept it all himself. Pretty normal. But it looks like you guys have been catching up on old episodes on YouTube and Spotify, Apple Podcasts, all that stuff. We really can't thank you enough for all the views and listens you guys have been doing. I think it's easy to say we've gotten a lot more out of this than we thought we would, and people have appreciated more than we thought they would.
Yeah, and we like to, tell everybody we're international as well. I think we're up to 5 additional countries.
It might be 6 or 7 now.
Yeah, I mean, can't count, Peter.
That's
how we're growing.
More states. So today, as you're going to see in a second, we have Peter Frei back with us. The conversation we're going to have today, we try to sponsor on most days on the Facebook group, Real Estate On Site. So if you haven't signed up, if you're on Facebook and you haven't got on Real Estate On Site yet, please do that. We try to do these conversations on a regular basis on there. So lastly, we'd always love to hear from you guys. We want to know what you think about the current episodes. We'd love to know what you think we should do for future episodes. So as always, Dan's at dansonsite.com. We want to hear from you. So today we got Peter Frei back in the hot seat. Slight change of job since we last talked to him. But you guys might remember he was in for a mini episode on the multifamily market update. And we said then we wanted to have Peter back for a more in-depth conversation. So this episode might actually run a little bit longer than some of our episodes, but stay with us because there's going to be a ton of information today. Peter's the best of the best when it comes to this stuff. So I think we'll be able to dig a little deeper and find out some real stuff. But before we get into too much of that stuff, Peter, how you doing? And then tell us a little bit about what you're doing now.
Yeah, well, first off, thanks for having me, guys. I enjoyed doing this last time.
It was well received, that first episode.
That was just like
crazy viewership.
It was like 2 minutes, right? Wasn't it? Or something?
Yeah, it was a little bit longer than that, but something like that. Not much.
So yeah, I'm pumped to be back. So that was maybe 2 months ago. Right when we were filming that, I was kind of in the works with changing from Omni Partners to a new job. So now I'm doing acquisitions at NewStreet Properties. NewStreet Properties is a Omaha-based family office. We invest in multifamily, industrial, medical office. Those are our main 3 products or food groups that we invest in. But yeah, we've been investing for 30 years. I've only been there 2 months of that 30 years. So.
Well, the family that backs that is Logier, correct?
Yep. So we're the family office for the Logier family. Logier family owns the Logier Corporation,
which is mainly store fixtures for retail.
Yep. Based in Omaha, they have plants throughout the country. I think 2,000 or so employees, 2,000 to 3,000 employees.
And we should say we get this all the time when retailers come to Omaha. If you're, it doesn't matter who you are. Target, Walmart, I think Ross, TJ. They buy all their fixtures come from Logier generally.
Yep. So they're the largest U.S. manufacturer of store fixtures. So essentially, if you go to Target or Walgreens or any sort of store, anything that sits on a shelf, there's a good chance it says in really discreet writing on the side, Logier. So yeah, they've been an Omaha company since the early 1900s. Pretty kind of low profile, blue collar manufacturing company, but have done extremely well. And now we're putting some of that money into real estate.
Yeah, something nobody ever thinks about, but obviously desperately needed by retailers everywhere. Mm-hmm. So you guys do basically the investing into real estate for the family. What kind of product are you guys looking at nowadays?
So our current portfolio consists of a little over 3,000 multifamily units, mostly in Omaha and Kansas City. But historically, we've owned stuff kind of throughout the country, throughout the Midwest and a little bit in the Southwest, like Texas and Arizona. And generally stay away from the coast or any really large primary markets like Chicago or New York or LA or something. But right now we're looking at multifamily, both acquisitions and developments, industrial, both development and acquisitions, and medical office, or single tenant office as well. Okay. It doesn't have to be medical.
Well, on the last episode, some of the feedback we received is it was really interesting to hear how people underwrite, I guess is the right word. And I know that one of the first questions people ask when we have something for sale is, what's the cap rate? But, a true investor or a true developer, they look beyond that. Not just cap rate, maybe it's IRR, cash on cash. Can you walk us through some of the steps on how you go through things and how you identify and quickly decide if it's something you want to pursue or something you just get past?
Yeah, the cap rate is the most commonly kind of referred term probably in our industry.
Yeah.
And for good reasons, because it means a lot. And it's the best quick metric you can use to value something or to get a sense of like.
It's kind of like the first question, maybe
Yeah.
I like it or I don't, then you dig deeper beyond that.
Yep, seems kind of expensive, seems like a good deal.
Right.
But the market's pretty efficient, so if it seems like a good deal, if the cap rate's too high, there's probably a reason for that. And vice versa, if it's really low cap rate, there's probably somewhat of a thinking that it is that low. Now you have to decide where you want to fit in that spectrum. But yes, we look at cap rates. They are, cap rate's a good quick measure of value, but they're a better measure of value for commercial properties. So a lot of the commercial properties we invest in are like industrial and single tenant office or medical office. And most of those are long-term leases with triple net lease structure, sometimes absolutes. Most of the time the landlord bears the responsibility of the roof and structure and exterior walls or something. But you basically know exactly what that NOI is going to be. It's set in the lease and you have very little expense risk over the term of a 10 or 15 year lease. Mm-hmm. So that being said, the cap rate then is actually the cap rate. Conversely with multifamily, NOI is highly subjective and can vary year to year. It depends on a lot of the expenses the landlord bears. Rents can change month to month for tenants.
And it might also, I think this is a good point, whether it's a multi-tenant commercial property, maybe multi-tenant's not enough. Maybe it's a large shopping center or a large office building where you have lots and lots of tenants, or multifamily. It can come down to just ownership strategy, management strategy, about how greatly that NOI can vary, correct?
Totally, yeah. The more tenants you have generally, the more variance you can have in NOI. Now, multifamily, it can vary a lot, but also because there's so many small tenants, you have a 100-unit property, you have 100 tenants paying you, and there's such a large amount of, there's
long-term tenants, there's quick-term tenants.
Yeah, it's really easy to re-lease a unit versus to re-lease 10,000 square feet of office. It costs a lot of money and takes a lot of time, there's a lot of fees involved. So that's why people love multifamily, because it's pretty consistent cash flow. But that being said, NOI can vary. And the other thing is on multifamily cap rates is that what is the actual cap rate you're buying it on? Is it the pro forma cap rate of what they think it's going to be next year? Is it the actual historical or in-place cap rate?
I mean, after 08, you think pro forma's used a lot? I mean, people use the word pro forma like, it's going to pro forma this, but...
So let's back up and I know there's a lot of people who watch this that know all this lingo that we're flying around, but if they don't know, explain really quick what's a pro forma.
A pro forma is just a forecast of cash flows. So I think that I'm buying this property today. What are my cash flows going to be in year one? My revenue and expenses and my income, or my profit, I guess.
And a broker may showcase the very brightest future.
Yeah.
Pro forma.
A broker does that?
No, I don't know what you're talking about.
And as they should, that's their job to market
Never
the
done
property.
That before.
They're representing the seller. They want to sell the best price, and their job is to paint
the prettiest picture.
Paint the prettiest picture of the property.
That's our job.
Now, I think they should still be grounded in reality and not lie.
And hopefully they are.
Totally
grounded in
And most of
reality,
them, yeah. So
nothing but reality.
But on the revenue side, you can say, well, pro forma market rents are way up here, and here are some comps to why the market rents are there. So the new owner can then come in and say, we'll easily be able to drive up rents to that price. And expenses, you can say, well, we've been spending so much money on XYZ and we way over manage it. So really expenses should be way lower. Yet they're saying the pro forma NOI is really high. It's higher than it is now. So that's a pro forma NOI. But there's a lot of risk. I have to do a lot of work to get there. I have to push rents, which who knows if I can do that, because your comps to rents may not be comparable.
And who knows what it does to my vacancy rate to push rents.
Yep, I push rents, vacancy probably goes up. It might cost me money to renovate units. It's stressful in management to do that. Who knows if you can get expenses down? And usually, if you are decreasing all your expenses, there's probably a consequence to that. If you think you can get decrease payroll by a bunch, well, maybe you're not going to be able to hire as good employees. You won't do as good of a job. So essentially, the performer rent, the performer NOI is something you should look at, but really, buyers want to buy on what the real income is, what the real NOI is, the in-place NOI, and sellers want to sell on what it could be in the future. So it depends on the markets where how big the disconnect
is there a certain return, theory that you prescribe to? Like, is it internal rate of return, or are you more concerned about cash on cash? I know this can be very investor specific,
right.
Every investor, but in your, let's say, perfect, textbook world, what's kind of the return gauge you're using to determine if it's a good investment or not?
Right. Yeah, you're right. It's all investor specific and depends on what the investor and their investors, what
Sure.
their goals and what their risk tolerance is and where they want to fit on that risk return spectrum. So it really depends. I will speak as in terms of like the company I work for now and framing of how we look at things, and we are cash on cash buyers. There's three main metrics to look at for return, and they're cash on cash, internal rate of return, and just kind of a money, a multiple in equity. I give you $1, I get $3 back. That's a 3x. That one's not used as much because it doesn't take into account time at all.
Right.
I could give you 10x return over 100 years probably, and you probably wouldn't be super happy, or maybe you would. I don't know. We're not going to be alive to see it. Yeah.
And that's always thought the great thing about the IRR does for you. It really takes that into account, and it gives me an exit strategy, and says when I'm out on this day, hopefully I've able to sell it for this. I've gotten all this money over the course of the term, and then it kind of gives me an overall picture.
Yep.
But the cash on cash makes a lot of sense too, because then I know here's my investment, and then annually this is what I'm getting back or should get back every single year.
Right. So if let's say I'm a syndicator or developer and I'm raising money and I want to get you guys to give me money to go buy real estate, and you guys want 5-year holds or 3 to 5 year holds, I'm probably going to pitch you on an IRR, because the IRR includes not only cash flow the property receives, it includes the principal pay down from our debt that we have, and it includes any appreciation, right? Because it takes those cash flows, and then when you sell it, you get your principal back, assuming you've paid down your note, and any appreciation. And the IRR just kind of smooths that over to give you an annualized rate of return. So if I'm an investor looking to invest in like a syndicate or something, I can say, you're saying you think you can get 15% IRR, and in the markets, I think I can only get 8 or 9, and I like the risk profile of real estate, so I'm going to bet on you guys to give me that. Now, when you're getting a lot of your return out of the exits, your cash on cash numbers are really bad, because that cash flow is unrealized because you haven't sold it yet.
Well, and what you're really doing is you're taking a huge risk that for some reason I haven't been able to get cash on an annual basis, but when I sell this, I'll be able to make a huge profit over what I bought it for and what I put into it.
Yep. And the main things wrong with that is who really knows what you're going to be able to sell for.
Yeah.
Now you can apply an exit cap rate to the property, and a lot of times those can work, but you're either banking on cap rate compression, the cap rate's going down, but what if they go the opposite? What if they go up, and then your 15 IRR turns into a 6 or something?
Right.
What about across like the nation? When you have, what are you seeing differently on the East Coast versus West Coast and Midwest for the IRR numbers or the cash on cash or even cap rates? Is there much fluctuation at all? Is it depending on the age or where the location is or condition even? If there's a need for, big, if there's a lot of deferred maintenance on if it's older, if the roof shot, etc.
Right. Well, let me I'll answer a cash and cash question and the difference on that and how we do that, and then I'll get to
Perfect.
cap rates. And
Go for it.
It's your show.
Well, yeah, okay. So IRR includes all those things we talked about, principal reduction and appreciation. But cash and cash is just, what am I getting? I buy this property, how much cash flow is coming to me after debt, available for distribution as compared to the equity I put in. So it's just a cash return number. And we look at that on the first year basis, and then over some sort of period of time, an average basis. So we might say we want to get 6% our first year, but over a 10-year hold, we want to average 8 or something like that. We're going to bank on, especially with commercial or like an industrial building, you have baked in rent increases. So you can really accurately project
More longer term leases and everything else.
You can project a return. Yeah. You know what your rent growth is going to be. With apartments, you might say it's 3, you might say it's 1. You don't really know what it's going to be. So we are cash and cash buyers in that sense, but that works for us because it fits our investment strategy, which is we are low leverage, long-term buyers. So if we want to own something for 20 years plus, it's futile to try and predict a exit cap rate to come up with an IRR to say, well, if you hold this for 20 years and sell it for a whatever cap, we'll get a 20% IRR. It's like, we just don't know. So let's focus on what we can control, which is what we buy for, the debt structure, and our cash flow, make the decision on that. And there's a lot more to consider past just, we don't just say we can get a 7% year one, so buy it. We have to consider all these external factors.
So if I'm looking at a strictly cash on cash basis when I buy an asset, does that steer me away from value add?
Perhaps. So we specifically will do more light value add, management efficiencies. Maybe we think we can increase rents by XYZ, but we're not going to come in and strip units and completely heavy value add a property, taking a 70s product and trying, C 70s product and turn it into a B product.
Redevelopment.
Yeah, not so much of that, but but if I'm someone who does want to do that, because that's a popular strategy and you can do really well with that, it depends when you're trying to sell it, I think. If you're trying to sell it in the year, you're trying to buy it, renovate units, get income up, and then sell in year 3, your cash and cash number won't tell the full story because it might be negative.
Well, and
so that's why IRR is maybe a good metric to use.
And IRR is tough, I think, because so much depends on the exit number. Mm-hmm. What can you get out of it? And obviously, the longer you hold an asset, the tougher it is to get higher IRRs. Whereas if you can buy an asset, put a bunch of money into it, really push that income, and then flip it in like a 3-year period, that's when you're going to see the biggest bang for your buck there.
Yeah, you can squeeze IRR numbers by highly leveraging and selling quicker, right? You can do a couple things, using kind of financial engineering returns by getting interest-only debt that increases maybe cash flow or whatever, but it's just riskier because you have more leverage.
It's easier to manipulate, but it also, there's a lot of people that's
the grinder group. They like to go in and find that and crank it and look for quick turn and burn. You guys are the more long-term people.
Yeah, people can do really, really well with that, and there's nothing wrong with it. It's just a higher level of risk, but they probably get higher returns, and it's maybe a little more based on the cycle where you're at in the cycle, depending on that market.
Yep.
Omaha's a little more like this, so maybe you can always kind of find it. Sometimes better than others, but in more high volatile markets, there's probably great times to do it. And you just don't want to be the guy in the middle of it when the music stops.
Well, and I always
get in trouble.
From just taking a broker break for a second, value add has become such a sales pitch now, and I feel like in some regards it's driven up competition on so-called value adds that it drives the price up so much that by the time you actually buy it, you're like, how much money can I really afford to put into this?
Well, construction costs, everything's going up. It's a tough game, especially around here in Omaha. Well, maybe even the Midwest. It's hard to find those anyways. The real cherries that are sitting out there.
You're exactly right. I think it used to be that you would pay X percent, whatever cap rate for a Class A property. This is multifamily, and you'd pay X minus whatever 9 cap for a Class C property because it was seen as higher risk, more expense risk, maybe some deferred maintenance, worse tenants, more work, whatever. Not as much rent growth opportunity. But now when you slap value add on it, that has compressed that cap rate because they're saying that I'll pay more for it now because I know I can do all this thing and get my income.
Right,
really
I can lower vacancy, I can push rents, I can decrease expenses, all those sorts of things. But if it's in a horrible location, you can put a whole bunch of money into it, but it's still in a horrible location.
Yeah. So it's just a riskier strategy, but it works really, really well for some. Some firms are very successful at it.
So Dan, I think, was asking about what are you guys seeing in different markets? Because you guys are shopping kind of all over the place, or at least in multiple markets. What are you guys seeing in all those markets?
So your point to cap rates, I think in general, the money flows from the coasts into the Midwest.
Primary in and out.
Yeah, primary markets, LA, San Francisco, New York, Chicago, Dallas, Houston, those markets cap rates are the lowest, and I think it's because people see them as less risky. There's a lot of rent growth there. It's harder to develop in those areas, so the barriers to entry are higher, and there's money coming in internationally to those markets. And then, so the investors who are investing in New York, when things get too frothy, they then go and invest in secondary markets. They go move to Denver. They start investing in Denver. Or they go investing in Charlotte or something like that. And Denver investors, they go, we're not getting a returns here. We're going to go to Omaha, to tertiary markets. So that's where we've seen the cap rate compression in Omaha over the past, what year is it? Call it 10 years. Has mostly been driven by people in those secondary markets coming down to Omaha. So with something like COVID happening, I think one thought is that a lot of the international investment might start drying up into the primary markets. So then the people who are investing in the secondary markets won't retreat and go back to the primary markets. And then the people in the tertiary markets might go back to the secondary markets. So that could help alleviate cap rates.
Are you seeing a lot of that?
Alleviate's the right word, but have soften cap rates.
Are you starting to see that happen?
No, not yet.
Well, and let me ask.
That's the wishful thinking.
Have you guys seen less properties on the market for sale?
Yes, 100%.
So if there's there's fewer sellers in New York City, let's say, those guys that are still, even if some of that international money dries up, there's still some international money there, but there's fewer sellers. So there's still bound to be people in New York saying, all right, we still got to go to Denver, or we still got to go to Charlotte or whatever. And it still pushes down, because then when you get to Denver, there's fewer sellers in Denver. And then those guys come to maybe Omaha, but there's fewer sellers in Omaha. So it's almost like a whole cycle that never ends, maybe?
Yeah, maybe so. I have no idea where cap rates are going to go. I mean,
we're crystal ball lookers.
Yeah, I don't know. And it's maybe fool's errands to try and figure that out. That's why we like buying, long-term good real estate on a cash-on-cash basis. Because then if cap rates swing up or swing down, it doesn't affect us because we're probably not selling for 20 years. So we're probably going to own this asset through a couple cycles. So
there's a really interesting, Dan and I, years ago, a guy came in who we know very well, came in, gave us a presentation on cap rates. And basically his presentation was, if you go back 30 or 40 years, cap rates haven't changed. They've essentially stayed the same. There's this misbelief, was his theory, that cap rates go up and down, but cap rates don't change. What changes is income on the properties change. And so the value of the properties goes up and down, but it's not actually correlated to the cap rate, it's correlated to the NOI of the property. And so cap rates stay, NOIs go up and down. And so in a down market, what happens is you can buy properties with a lower NOI, and then as the market gets better, the NOI increases, you can sell the property higher. It was really interesting, but I've been through 08, and the truth in 08 was there just wasn't money to lend.
Well, the banks were in trouble. I mean, that's what's different now. I mean, the banks were just struggling. You couldn't go get it if you had to.
Yeah, values can go up for either income growth or cap rates, basically the multiple you're paying on it. And the cap rate is probably most indicative of debt, of what you can borrow, because you're basically borrowing a spread over. I can buy for a 6 cap and I can borrow a 3, and that's like my return. That's my spread.
Well, and truthfully, since 1980, interest rates have basically been on a downward trend. We might have a guy in soon who is one of my mentors who used to always talk about, you think development's so hard today, you should have done it in the 70s when we were working with 18% interest.
But there were probably 20% cap rates.
There were probably huge cap rates. And it's also a different world. There was a lot more I think there's still multifamily development to be done, probably lots and lots of multifamily development to be done around the country. There's, little retail development to be done. There's large swaths of industrial development, obviously, to be done. Office development, who knows?
It's on fire right now.
And I guess that's maybe an excellent question for you, Peter, is office. You guys looking at office right now? How in the world do you evaluate office right now when, there's all this talk about, will employees go back to the office? Won't they go back to the office? How do you look at it?
Yeah, I don't know what's going to happen in the next 12 or 18 months. I in general, I don't buy into the idea that one day everybody works in office and overnight we now work remotely and that's how it's going to work beyond. I think that remote work can work, but your company has to be structured and has to have processes in place and a culture that is embodied in remote work. And very few companies have done that. And the ones who have started as that, their founders built the company that way. So to say that a company, you can be XYZ company and then just be all of a sudden be remote working, you have no way to build culture. You have no way, if you're an employee, to kind of get ahead by putting in an extra.
Well, if you're an investment firm, how are you going to walk to someone's office to talk about something? I mean, that's an example, but how can that work?
The little conversations you have that really matter before and after the meeting.
Yeah.
And you don't have those when you're doing on Zoom. And I think the main thing is the people who make the decisions on whether we return to work or not are the people who want to be in the office. So
they are the people. They also are the people that own the office real estate, right, in large part. I found it fascinating. There was a big story, I don't know, a month ago or so about REI giving up their corporate offices. Mm-hmm. And then the buyer ended up being Facebook. And you would think if there's one company on the planet that could work from home, it would be Facebook. But then Facebook made a $400 million investment into expanding their offices. So it seems to me that we'll go back to the office too.
Yeah, I would think so. There's going to be effects, and obviously there has been. There will be long-term effects. I just don't know what they are. And all these thoughts I have about it are all regurgitated from things I hear. It's not like this is my original thoughts on the office market.
I don't know that anybody really can have an original thought on the office market either, though.
But to say, are we buyers? I don't know. My personal opinion is I see this as an opportunity when there's uncertainty, there's more risk. That means we can probably get a good buy right now for office. So we were in Phoenix a couple weeks ago looking at a single tenant office building there that we're pursuing.
They're going to stay in it?
So that's the thing. So we see it as people are shaky about office, so there might be less investment activity chasing office deals. So if we can get a long-term lease with a tenant we're comfortable with in a good location at a low basis, meaning that the price per square foot we're paying is at or below replacement costs, or it's whether their cap rates, whether it's a great cap rate or not, what we really look at is what are they paying in rent. Mm-hmm. Even if it's a market cap rate or one we deem acceptable, but if the rents are 50% higher than the market, that's a ton of risk baked in there.
So it's interesting. I used to work at a firm not so unsimilar from the firm you work at now. And there was our acquisition people there's a number of studies out there by super intelligent mathematicians, economists at Harvard and high ranking schools, basically say when you buy real estate, the number one factor should be location, period. It doesn't matter the condition of the property, the rents, the future of the property, all these things, because the thing that generates the lowest risk and highest returns are the location, and solely the location of the property. And so, you're talking earlier about going to New York City or, maybe LA or Phoenix or something like that. It makes a lot of sense that that's where you would go to buy, even if you're in the office market, maybe that might be a touch more risky, just because it's going to hold its value, because there's going to be some portion of people that are in offices. And if you got a good building in a good location, it seems most likely that's where they're going to be first.
Yeah, and that's why cap rates are lower in those markets, because there's a ton of people and people want to live. I mean, there's a ton of people there for a reason, because it's probably a good place to live for whatever reasons they are. So that creates a lot less risk.
For sure. Dan, before we get out of here, any further questions for Peter?
No, we kind of rolled through it all. The one big one I want to hear is just, what's going on around the country. I mean, so many people talk about, and I think you've kind of addressed it, is how Omaha compares. We've had a lot of people ask that. So it's good that you're looking at office deals in Arizona at least.
Yeah, and that's not the main thing we're probably going after, but if we see a good deal that we think we have an edge on for whatever reason. I mean, just around here, we have so many 100,000 square feet of new office coming on the market. We hope it's full. The word is it's full. It's, the time's going to tell here in first or second quarter of next year on how that's all going to turn out.
So I do have one final question. We've been talking about, investing with the idea that you have lots of money to put in investments, but you're also a small-time investor with, smaller investments. What, for somebody that's maybe watching this who says, I got $100,000 in cash that I can put in to something. or maybe it's $50,000 in cash I could put into something. What advice would you give to those people? Maybe it's their first real estate investment that they're doing, mostly on their own.
Mm-hmm. That's a good question. The most common thing to do, or a widespread thought, is to buy a single family home and rent it. And the good thing about that is that you can, it's easy to create value quickly and get your cash out. So I can buy a house, I can renovate it and re-rent it, and I can refinance it. And then I've increased value so much that I can pull all my initial cash out, put $50K in, I can refinance it out, and now I own that with zero cash in, and I get cash flows.
And can do it again.
And then I can do another one.
Yeah.
Then you can recur, because if you put your $50K in and just buy and hold it, then the $50K is working for you, but you're done. You can't keep leveraging it. The problem with that is it's so time intensive. It's hard to scale.
It's back to the value add question. I mean, can someone go in and rehab apartments? The same kind of thing. There's a lot of work to single family.
And the reason why there's probably more opportunities in like single family homes is because there's a lot of people doing that, but there's not a lot of sophisticated large firms doing that. Every apartment deal gets so competitively big because there's firms with a lot of money with highly, smart people who know what they're doing, highly skilled, and go and do it.
Well,
apartments are, a single family home are competing against Joe down the street or something.
Every house, every individual single family house, you have to start fresh. Mm-hmm. You really have to start from scratch. What's the plumbing like? What's the electrical like? What's all this stuff? If I have an apartment building and maybe has 25 units in that one apartment building or whatever, I generally, once I do the inspection, it's going to be generally the same on every single unit. So it's going to be paint, carpet, or whatever, just over and over and over again. Where every single house is different and the needs are different, and you start over again. But it does provide opportunity, especially if maybe you're handy. Mm-hmm. I always suggest to people if that's the route you're going to go, and it's a great route, and I've known lots of people that have built, good. Family wealth or small, personal wealth, doing that kind of stuff, it's best to be handy. You better know how to, change out a toilet if you need to change.
If you're a third party hiring, you're going to squeeze your profits.
So you see yourself, and then
you got to do it yourself.
Get to a point where then you can hire people, so you have scale to make it work. But that's a lot of work. So what you do with your money? So that would be an option if you want to be in real estate. You can pool with some other people and go buy a building, and then be a little more passive. Taking it to the next level, you could invest it with a syndicate. There's a ton of firms in town or all the country who you can invest money with.
Do people invest with you, or do you invest in partnership with other groups, or is it just mainly your own little core of cash?
It's the stuff I've done, mainly just a couple projects, and it's been with partners of mine or friends and family that I do stuff with, and that's usually how a lot of real estate is done. A great option is investing it in a REIT, a real estate investment trust, and you can do that publicly. They're publicly traded REITs that they have all the information online. They're all through the SEC, or private REITs, which are also, they disclose all the information. The idea with that is you're putting your $50K and you're spreading it out over maybe 10,000 units throughout the Midwest. Mm-hmm. or whatever they do. They might be apartments, might be office, might be industrial. You can invest in all these REITs, and they have to distribute a lot of the cash, and you can take that cash flow and reinvest it or take it as income. So you're not going to double your money overnight, but it's a really good way to get all the benefits of real estate, which are
rarely are you going to lose your money overnight.
You're not going to lose you distribute your risk out. You're putting your money in the hands of highly capable, for the most part. They still make mistakes, as we've seen in 2008, but you get all the benefits of real estate, even the depreciation, and you don't have to touch it. So that's an okay way if you want to get exposure to real estate and you believe in real estate. And so many REITs invest in the Midwest or in primary markets, or there's so many that do different types of things. You can kind of pick your strategy that you think you believe in, and you can kind of forget about the money. Other than that, or you just go out and buy properties yourself with your own money, like apartments or office or whatever. The problem with that is you're betting on one property. So if that goes wrong, something. Your risk is on that one property. So it's high risk, but then you have a lot more of the upside. You also just need some amount of capital going, which is a lot of times hard.
And I think it's hard to lose all your money on one property. What happens most commonly, it seems to me, is when you put all your money in on one property and it doesn't work out the way you hoped, it just takes you that much longer to be able to get your money back out of it.
Yep.
And I will say, just maybe a disclaimer here. I think Dan and I bet that Peter would be for this too. If you're going to do it on your own and you're not maybe an experienced, savvy real estate investor, build a team around you. Make sure find a contractor that you're comfortable with, that charges good prices. Find a real estate agent that you're comfortable with that can really provide advice for you in your specific market. Make sure your accountant is up to date on what you're doing and that they have experience in this stuff. A lot of times, depending on what kind of investment you're doing, it's really handy to have an attorney kind of on file that you can call. And I always say real estate law is different than any other type of law. So make sure it's a real estate attorney that you're dealing with. Just the basics. Have a team in place. That will be your best chance to, be successful, I think, in your real estate investing. Before we get out of here, Dan, anything else?
I have one question that I've always thought was interesting is as these new apartment complexes are building anywhere, any market, what are some of the amenities that are being put in there to draw the tenants to them over maybe an existing one or another new one?
Right. People got really creative, I feel like, in the last 10 years. It's not only the pool and the
because they're building some nice stuff right now.
Yep, it's not only the pool and the workout facility, but now they have all these different little add-ons they can do between bike washing, dog washing, the package systems in the lobby where you
almost like you don't even have to leave you may leave for work, but there's restaurants. Some of them are putting in restaurants,
bars. The big thing right now is like resort style pools, where it truly are. I mean, it feels like you're at at a nice resort hotel, and you can drink there and do whatever. So that I think most of the stuff that the amenities you built with apartments is you're in some way you are paying for it because those are really expensive and they're just. But
you want it. I mean, it's a luxury for it.
Yeah, most of them are marketing tools, in my opinion. I think people use pools, but they rarely use the gyms because most of the time they're not good enough to.
Well, I mean, probably may want to use it.
Dan works out everywhere he goes.
I did ride my bike.
And so, but you walk through and go, wow, that's a sweet gym, and wow, that's a sweet whatever. But
you just see so many units and so many complexes with so many different developers in every little city, and you just wonder, why are they? Could be job, obviously location, but why are they picking that over one across the street?
And that's why that's the arms race with amenities, especially in bigger markets like Denver. They're building a ton. They built a ton downtown, and I mean, I've been in a couple of those, and it's ridiculous. Massive studios for Pilates, and they have full Peloton. Rows and rows of Pelotons you can go on. But it's mainly just it's a marketing tool, I think. And then you pay for it with the higher rents. And so you need to have a lot of units to spread out that investment over all the units, and you need to be in a place that gets high rent. So we have those amenities in Omaha, but it's not as crazy as it is in other markets. I think we're going to see. I would rather build apartments with less amenities and have lower rents. I think there's always a market for people who want to rent for cheaper, and we have a massive housing shortage in the U.S. So we need more units, whether it's single-family homes or apartments. And the biggest issue is building them affordable enough. And you cannot build, people always say developers just want to build high-end, nice apartments, don't have to build affordable ones, because you can't. I mean, the only way to build Class B apartments is just building Class A and waiting for 20 or 30 years.
So you've gotten into a whole nother discussion that and we don't need to get into it now, but I would love to have you back again, somewhere down the road to talk about that, because that is, you watch politicians, I don't care, it doesn't matter what side of the aisle you're on. You watch politicians speak, and especially in communities like maybe San Francisco or all up and down California, but even in Chicago or inner cities, you talk about, well, we're going to have to, there's a pressure on rents, and then we have a shortage of units, and now we have a supply and demand problem, and then on top of that, you need to build more units, but construction prices are so high. And truthfully, if you watch the news at all, and apartments are single family is subject to this. Apartments are subject to this. Lumber prices are through the roof right now, which makes it incredibly expensive to build. Not to mention that there's not enough employees. You can really send me down a whole tangent here. There's not enough employees working in the trades to begin with. So the cost to hire somebody to come on and build is expensive. Now, lumber is super expensive. And you're right, you can't build, and it doesn't matter what mass you're at, you can't build affordable.
Yeah, the only way to do it is you can use low income housing tax credits. Those they're cumbersome and they're just really hard to do and put together. But you need some sort of subsidy to make something cheaper. So that can work. So I don't know the right answer. In general, any policy that limits the supply or that limits the housing supply makes things more expensive in the long run. So we should be encouraging more. In general, if you increase the supply, you're going to lower the cost of housing in the long run. And we should be making, I think we should be, I'm not trying to make this political, but we should be trying to make policies on a 50-year timeline, not like 5 years.
Well, don't get me wrong. I agree 100% that we're a little too much react in the moment as opposed to think long term. But we'll leave it there for today. Peter, really appreciate you coming in. I appreciate I think this is an area where a lot of people just don't have the expertise that maybe they should, or at least that they would like to. And so hopefully we've put a lot of information out there that people find helpful. If you guys have more questions, if we can be of help at any point, feel free. Dan's on site, or Dan's at dansonsite.com. Get a hold of us. We are more, we do have a business and we are trying to make money, but truthfully, we do this not for that. We do this to provide information to the community, to try to make the real estate community a better place. So if you guys have questions that we can answer, we would love to answer them. The three of us do this because our passion is this, and at least Dan and I, if we can provide you with education or as a resource to make you better off in your real estate venture, reach out, because we would love to do that. As always, you can find us, all our old episodes at dansonsite.com. You can always find us at YouTube, Dan's On Site, Apple Podcasts, Google Podcasts, Spotify. Check us out on Facebook, where we try to have these kind of conversations every day. Real Estate On Site. Peter, thank you so much for coming in.
Yeah.
Really
you guys
appreciate
add
it.
like my email, or I can do my new email.
Yeah, we'll please put it out to the crew.
Right
Everybody,
now. Peter.Frei, Frei, at NewStreetProp.biz.
So
NewStreet Property.
You can find all guest profiles at dansonsite.com, and Peter will be, by the time this episode's up, Peter's guest profile will be on there. His email address will be on there. So
reach
do you
out.
have a new picture or anything with the new gig?
I don't think so. I don't even know if I'm on the website yet.
well, we'll have to make
We'll
up
put
the
you on
bio,
our website.
We'll definitely
Just
put
direct everybody over
Yes.
there.
Yeah, we keep a pretty low profile, so that this is about as much marketing as we do is sending me on something like this. But yeah, feel free to reach out with any questions anybody has. I like talking about this. Also from
Brian's always welcome.
From
He
a
can certainly come too.
yeah, he'd come too. From a marketing perspective, and we're buyers, and we're still really active buyers in Omaha, Kansas City. We're buying an industrial building in Frisco right now, Phoenix, Louisville, Indianapolis, Des Moines, kind of any Midwest city,
Dallas, which seems
Phoenix
like the
Phoenix
hottest
isn't-
market on the planet.
Yeah, so I say that we stay away from the primary markets, but then I say that we're doing stuff. So you never know. It's a suburb, it's a suburb of a higher suburb.
Yeah,
of Dallas.
no, I get that. Seems like when you live here, seems like everything is happening in Texas.
It is so. I mean, Dallas is so big; it's unbelievable.
The number of cranes in the air in a given period of just interstate is crazy.
Yeah.
I mean, it's nuts.
Yeah, that's why.
But I think their stadium is second rate compared to the Rams stadium now. I'm just going to say that for Jerry Jones fans.
We might have visitors from Dallas. We don't want to.
That's true.
Great stadium.
Great state of Dallas, Texas. Great state of Texas. Anyway, that'll be enough before I say anything else stupid. As always, Dan Goley.
Thank you very much for coming with us.
I'm Dan Dutton. Find us, dansonsite.com. Thank you very much for joining us.
Thanks again for joining us. Find us on Facebook, at YouTube, Dan's On Site. All your favorite podcast platforms, Apple Podcasts, Spotify, Google Podcasts, and more. We would love it if you hit the subscribe button and also leave us a review. Reach us at dans@dansonsite.com.